The Underground, Ideas into Action presents an Underground Chat, where we bring the underground conversation to you. Today's chat, the Australian and U.S. Connection, Part 2 of 3, with Mark Worthington, CEO of Australian Mutual Bank.
And when I think about the world and our connections on a global basis, we have this opportunity. We start with financial inclusion, but we were born out of social justice, right? And when we go back to those roots and we understand what it was all about, I have conversations with people that say, Sue, you're talking about social issues here, and we're a credit union and we transact financial services. And I said, but we're a cooperative for a reason. And so let's go to that, kind of that shift of how does this all integrate. You are called a mutual bank. Tell us, let's start there. What transitioned where you still call yourself, a credit union, but you're called a mutual bank. So tell us about that. What happened?
Sure. We just as in the US, I think we've had trouble with the words credit union and getting the meaning of them across. And if you ask people, most people don't know what a credit union is, and pretty well everyone over the age of 6 knows what a bank is. And we have noticed here. We have noticed here that in the US and in Canada, lots of credit unions started dropping the words credit union off their names. And we could look at, Van City, for example, in Canada.
Yes.
We had a WOCU visitor to our local domestic convention here last year, year before, should I say. And his credit union he mentioned was called Congressional Federal. And it wasn't Congressional Federal Credit Union, it was Congressional Federal. So we're really reflecting what you guys had already been doing, and that's dropping the words credit union off names. What we decided here is that the word bank, even though people don't like banks, they are respected. The idea that safe as a bank or take it to the bank or whatever the expression is an expression of safety and security. And so we when we were allowed to use the word bank by the regulator, we just prefaced it with the word mutual to show our member-owned difference. And now I think of those 70 odd cooperatives or credit unions in Australia, about 27, 28 of them are now banks, are now mutual banks. And it's worked quite well. There's never been a bank failure in Australia either. And it's been accepted by the members, more importantly.
But the cooperative structure remains, like you said,
absolutely
member-owned. Okay.
Yeah.
And that was a key point.
Yeah. And the word mutual bank provides for that structural difference.
So in the U.S., mutual bank means a little different. It's still very similar, but opportunity to then convert to a bank becomes something that's controversial. But I'm fascinated in that journey because, as you know, many of us in the U.S. look to Australia, look to Canada with some of the changes from a taxation standpoint and the regulatory model. So are we going to see that transition? I think that you just mentioned, I have many clients that credit union isn't prevalent in their name any longer. Do you think we're going to continue to see that movement?
I do. I certainly in Australia, there's no reason to not change. Now I know in the US there are reasons to not change, and taxation that you briefly mentioned there is one of them. This is one of our great mistakes, I think, in Australia, the Australian credit union movement or industry. One of its great mistakes was to lose our tax exemption, which we lost back in 1992. And the reason that we lost that tax exemption, by the way, is, in my view, that, I know at the time, the government approached our national association and said, justify your tax exemption. Tell us why we should continue it. And our national association then raced around trying to aggregate all of the social responsibility activities that we do and measure them all up in dollar terms to be able to go back to the government and say, look, this is what we do and this is why we deserve this exemption. And we couldn't do it. We couldn't show them. We couldn't show them that we were acting in a socially responsible manner. what we were doing is we were either in building our inefficiencies and using the tax exemption to pay for it, or building reserves more than what we should have been, because it was the tax component that we were using to build that stability. It was mostly the inefficiency, in my view. So the government said, well, look, if credit unions, if you're not going to act in a socially responsible fashion, then we'll tax you and we'll spend that money in our socially responsible fashion. And that's what they did. So they introduced corporate income tax. We don't pay state taxes here. We only one corporate federal income tax. It was introduced at 10% in 1992 and 20% in 93, a full corporate tax rate of 30% in 1994.
Wow.
We currently pay about 27.5% is our current corporate tax rate for our size. So in my view, that's why we lost it. And when I look at US credit unions and I see credit unions buying banks, that's a red flag to government as far as I'm concerned. I mean, a non-tax-paying organisation clearly has a benefit, as a competitive advantage over a tax-paying organisation. And another example, and these are just personal views, of course, but another example is where you have a couple of $1 billion credit union in the US, and they might be making, say, let's call it $8 million a year. My view is that in order to prevent the loss of your tax exemption and not follow our mistake, then that organisation should be calculating what its federal tax would be. I know you pay state tax anyway, but calculate what that liability would be, and then ensure that the social responsibility activities, the social responsibility expense or investment, is equal to what that liability would be. So if it's, say you're making $8 million a year and, I don't know, 20% tax rate, less the state tax, well, maybe, I don't know, call it $1 million, $1.2 million. Now, that credit union might say, well, we're putting $400,000 into social responsibility activities. We have volunteer hours are worth $100,000, so it's $500,000. But in reality, the tax exemption is 1.2, but they're only spending 500. So my view is they should be spending the 1.2, aggregating those amounts, reporting it through state associations to your federal organisation, and then when your tax exemption is under pressure, whoever it is, would turn around and say, well, look, if you take our tax exemption away, all of these activities, all of this investment and all of these outcomes would go. And they really need to be, you need to be able to balance them in order to keep them, in my view. But that's just a personal
No, I think that you're really showing a bottom line impact to what a standard corporation would call goodwill and what we put into our balance sheet, right? But one of the areas that interests me is what's the net worth requirements in Australia, where we have a regulator here that's looking at net worth. The average is 9%. And so 10% is even better, and well capitalized is supposed to be 7%, but as you know, what we've gone through in the last 10 years certainly has put pressure on everybody to build those reserves. So what do you have in Australia? What's your minimum requirements for your reserves and your net worth?
Okay, ours is a little more complicated because of another mistake that we made. And that mistake was with regard to regulation. We're no longer regulated under a cooperative act or a credit union legislation. We were transferred into the Corporations Act, into corporations law, and we were transferred to the banking prudential regulator. And the banking prudential regulator immediately applied, and this was in the late 90s, immediately applied the standards that they apply to all the other banks in Australia, and that was the Basel Accord from 1988 and the various iterations of it since. So we report under all of those Basel prudential requirements, and so our net worth or reserve ratio is what we call a capital adequacy ratio, and that's calculated according to a standard formula of risk ratings of assets, so that you can directly compare a capital adequacy ratio between any ADI in the world, really, if they're using the same consistent approach. So our capital adequacy ratio is quite high at 21.3. If it was a reserve ratio, it would be well, it's 175 million of reserves on 1.65 billion of assets. So we're talking just over 10% would be our reserve ratio. We're one of the more well-capitalised organisations, though we're not the same as everybody else in that regard. It's the bad thing about the Basel regulation is when you see the Basel Accord was created originally so that investors could assess banks that transact internationally by knowing that their capital was calculated consistently. That's what it was for. Now, we don't transact internationally, and so we shouldn't have to go through all the rigmarole that we do in order to produce a number that doesn't mean anything. But we have to. And I think originally it was only Australia and British Columbia that had that Basel standards applied to it. But since then, that means, we've got all of these Prudential standards relating to, well, the governance of fitness and propriety, which I know you know about. We have public disclosures, we've deposit guarantee scheme, we have liquidity requirements, risk management, credit quality, large exposures, outsourcing, business continuity management. We even have a Prudential standard on data information security. So they're quite prescriptive here. And that's part of the reason there's only 72 credit unions, because apart from the tax exemption, forced a whole lot of credit unions to merge because those inefficiencies couldn't be hidden anymore by not paying tax. And the second burst of regulation occurred because of transfer under the Prudential regulator, which enforced these much more strict Prudential regulations.
Well, I think it's a forewarning, if you will, to those, especially in the U.S., because we're seeing the squeeze on money. Obviously, we're seeing the pressure on net income and the margins. And so the question is going to become, where do we cut? Do we end up cutting and becoming more efficient, as you mentioned, or do we end up looking at some of the programs that are fluff, right? The social mission type programs that we have that controversy over, and therein lies the problem, because ultimately, if you make that choice and it's not efficiencies and it's not digital transformation and it's not investment in the future, then you're giving up some of the things that allow for the differences. And so here we are at this, what I call crossroads in the U.S. Are we going to pursue systemic change in racism? Are we going to look at DEI initiatives? And in the past, we've enjoyed the fact that we haven't had to have CRA or Community Reinvestment Act because the banks had it because they weren't doing fair lending. And we're, as a credit union movement, we've never worried about that because we've been representative of the people and we've been very diverse. So I see these tipping points in our future, and that's one of the reasons I was so fascinated to talk to you today, because it's not just about us having controversial conversations. It's about the track record of what we've seen in the movement and the pitfalls, like you said, sharing not only the good stuff but the lessons learned. So,
mistakes, and we've made a few, that's for sure.
Well, there's
a few areas that we've been, we've done okay in here. I mean, the payments area in Australia is one
that's what I was going to add. I was going to move, but one thing I want to talk about just quickly before we go into technology is, how do you remain in that environment? How do you remain committed to the social mission? Is the board all in? Or is your regulator all in? I mean, I know that you've almost done some of the stuff purely on your own dollar and gone out and continued your work. Tell me how that's transitioned.
Look, it's really difficult. With the transfer of credit unions to corporations law and not having its own cooperative legislation, with the transfer to the Prudential regulation, it's easy to take one's eyes off the ball in terms of social responsibility activities, and in some ways we could easily be accused as simply becoming small, niche banks for the middle class. That's potentially what credit unions have become in Australia. We evolved out of industrial organisations as they did in the US, or geographic if they're country or regional geographic, and we've in some ways we've been regulated out of being socially responsible. Fair lending, what our corporate regulator calls responsible lending, is that we must ensure that someone has the capacity to repay a loan before we give it to them. Otherwise, it's predatory lending or considered unconscionable or what have you. And that's fair enough. That's a response to the payday lenders or attempt to get people in and put them in on high rates. But we don't do that. But the government came up with a responsible lending response to that and threw the net out, and we got caught in it. Now, responsible lending, from my perspective, and we have a fair amount of interaction with a trade union. That trade union, and I'll give you an example, came to us and said, where one of our members is suffering from financial and physical abuse at home, where she's trying to escape a relationship that she needs to get away from. If she needed a loan in order to make this break or to move away or to take her kids in somewhere, in effect, we wouldn't be able to do it because responsible lending would say we'd need to prove her capacity to repay. If she has a joint mortgage with her husband, we'd have to take his repayments into account. We'd have to involve him in the process. And this idea, it's a misnomer, is responsible lending. It's ticker box compliance lending, but it's not really responsible. And whereas previously credit unions would lend to people based on their character, someone who'd fallen on hard times, who had been a member for a long time, who we knew and trusted and felt that we could manage and provide some level of forbearance over arrears and lend people money, we simply can't do that anymore because we've been regulated out of it by a regulator with a one-size-fits-all approach who wants to catch the payday lenders but throws the net over us as well. And so we've got a problem with our social responsibility activities, and that's why here we tend to support charities that do the good work for us, or our international activities. I'll talk about that later, but that's definitely a problem for organisations in Australia. Is how, for our credit unions in Australia, is how we position ourselves in the market, how we own the social responsibility space, how we're perceived as being the ethical alternative, and someone said that a mutual structure or a cooperative structure is pretty well the only way a bank can operate ethically, given the way banks do operate. And so we've lost our way a little bit, but it's not all our fault in terms of we might just not have responded to regulators in the manner that we should have.
Well, and understood the legacy and the corporate model, and having, frankly, this idea that's always ever present, and that is that the structure of a credit union, and within the United States specifically, is to give an alternative, a fair alternative to people. And I think that as we get caught up, if you will, in being bigger and responding, and as you indicated, we still have that diversity in numbers of credit unions, but it's getting tougher. It's getting much tougher. And one of the driving forces for that is technology. And I know that all of you have gone through a transition with technology, and you have things that I'd like you to tell us a little bit about. But technology and virtual platforms and mobile initiatives and fraud and all those things are really hitting us right now. Obviously, we had to respond in a crisis mode, so we did that, and people responded valiantly. I mean, we've had a tremendous response on our credit union's part to what's happening with the health issues. Now it's starting to go longer, okay? And the idea was, let's get through this period, and then we'll go back, right? And we'll figure all this out. But as we continue to have this virtual environment, I think we're becoming more vulnerable and less tolerant, and consumers are going to be less patient because the seamless organizations such as Amazon and so on are starting to fill that space. So tell us a little bit about the technology journey and what you're dealing with there.
Yeah. It's been really interesting in the last 6 months with the move away from cash due to COVID. We've seen ATM withdrawals and cash usage and people entering branches. They've just, it's just halved It does mean that we're assessing the need for all of our branches. There's no point in spending, a few $1 million a year in lease costs if people aren't coming in. We don't want them. We need to be able to either provide better prices to all members. The greatest good for the greatest number, as opposed to just providing access for people who live near branches. But in terms of payments, Australia's been pretty good historically. I think Australian credit unions, interestingly, were the first non-US financial institutions to issue Visa cards in their own names. That was back in the 80s. So we've been issuing Visa debit and credit cards for 30 years, more than 30 years. So we've always stayed on the front edge of or we've tried to, with app development and contactless payments. In fact, when I was in the US in 2015, I made a mobile contactless payment in San Francisco using my phone, and just tapped my phone, and that was it debited my own Select Credit Union Visa card account back here. So and since then, we launched Google Pay and Apple Pay about 4 years ago as well. So all of that works. The latest thing we've done here in Australia is we've created something called, it's a rather boring name, it's called a new payments platform. But what it allows is for real-time instant payments across the whole banking sector. So members of Australian Mutual Bank, this credit union, we can make a transfer in real time to any other person, any other bank account in Australia. And by real time, it's maximum 3 seconds. And all of that is settled on behalf of each party. So that was introduced about 1.5 years ago. And we can also send about 280 characters of information with those payments. And that will be developed further so that more information can be made through that payment channel. So we're pretty happy with that. The reason that occurred here is the government effectively said to the major banks and the major players, and including credit unions, and said, we want to have this available for our citizens. So go away and work out some standards and agree on how you're going to do it. And we'll give you 12 months. And if you don't agree, we're going to mandate it, and we're going to tell you what you're going to do. And so everyone got together and agreed. And so despite the competition here, which is quite strong, when it comes to things like that, it makes sense to get together and work out what's in our best interests. And so that's been done. The other thing I think that we have that's a bit more interesting and doesn't happen in the US, and I know your US Postal Service has been trending in Google lately, but we have what we call here a bank at post arrangement. And so a lot of banks have made arrangements without the US postal equivalent, Australia Post. So my members can go into any post office and make a deposit or withdrawal, and they can pay bills. There's just limited basic transactions that they can make at post offices, and that arrangement's been in place for probably 15 years now.